This screencast is looking at Summer 18 Question 4, focused particularly on cost of capital. So again, I'm assuming you've read through the question. If not, pause this and read through it fully and try and make an attempt at it. This is one of the optional questions in Summer 2018 for 20 marks, so you roughly had about 30 minutes or half an hour to complete a question like this. So we're going to focus on part A and B together. In this one, we're asked to calculate the cost of each type of finance and then calculate the weighted average cost of capital. Now, of course, to remember, you need the cost and the market value of each source to get your weighted average cost of capital. And how we approach that here is typically 3 steps. You get the number of sources of finance, then you get the cost and the market value of each, and your final step then is to complete a Wacc table, which is your part B. So you take it in stages, do each of these sources individually first, and then finish it off getting the weighted average. So assume you've read through the question. In this question we have 3 sources of finance. So I would always, for a Wacc question, I'd always lay out the table and then do your workings underneath. So you have a source here, you have ordinary share capital, you have preference shares, and you have redeemable debt. So redeemable debt. So you have 3 sources of finance here. What you need to do is get the cost of each, you need to get the market value of each, and that will then allow you to get your weighting. So usually put it in a table like that. You're essentially looking for 6 figures here now. The 3 costs, which you get your 6 marks in part A, and then you need your market value and your weight to do part B, which is a weighted average cost of capital. And we're just going to lay them out for the examiner, working 1, working 2, and working 3. Nice and easy. Make it nice and clear, and you have a nice neat table at the end when you're doing your final answer. So working 1 here is your ordinary share capital. We're looking for 2 things. You're always looking for your cost of capital and your market value. Now, I'm a big fan, if anyone has had me in class, I'm a big fan of doing a summary study sheet for cost of capital. And it should look something like this. This is where you get each type of source of finance. There's only about 5 or 6 that come up. And you do a little summary, kind of like a cheat sheet, of how to get the market value, how to get the cost of capital. And then as you go through your study leave, you put in some extra tips. So for example, for debt, you might put in that debt is tax deductible. So you multiply by 1 minus t. And then the question column is to just collect a collection of past exam questions that have asked each type of finance. Because this Wacc comes up every year, and the examiner mixes up the combination of the types of source of finance each year. But start using this summary table in your study plan, and then as you get towards your end of year exams, you'll wean yourself off it and you'll essentially know it off by heart. So in our first question, we're looking at the ordinary share capital. We're told the current share price is $4.75 and a dividend has recently been declared and will be paid shortly. So that's very important here. That means it hasn't been paid yet. So the $4.75 is what we call a cum div price. That includes your dividend in there, so you need to remove that. So you're going to do $4.75 minus 0.28, and that will get you $4.47 is what we call your ex-div price. And that's an important tip to put in your cheat sheet. You're always looking at the price excluding any dividend that may be included in it. So we know our ex-div price per share is $4.47. The next thing we need to figure out is, well, what formula are we going to use for our cost of equity? There's 2 main formulas, CAPM, the capital asset pricing model, but we're not told anything about risk-free rate for this half of the question at least, or betas. But we are told stuff about the dividend, and we are told about the dividend growth rate, which is 6%. So what we're actually going to be using here is the dividend discount model. Now remember at Cap 1, you will be given a collection of formulae. So if we go to the back, if you go to the end of any Cap 1 paper, you're given a tables and formula. The first 2 tables are your present value tables. And then after that, you're given a collection of formulae, particularly this one here, the dividend valuation model with growth. And we're looking to find the cost of equity. So we know the formula is cost of equity is div 0, which we know is 28 cents, times 1 plus G over the price plus G. So what we might actually do is we'll snip that to have it. And remember, this is in your exam, so make sure you know what's given in the day of the exam, so you don't try and learn off too many things. And we'll slot that in here. So that's our dividend valuation model, just we have the formula. And then we'll sub in exactly what we're given in the question. So we know our div 0 is 0.28. So our cost of equity, which is signified KE, is 0.28 times 1.06. So remember, that's 1 plus G. Over the price. Now you always use the adjusted price here, 4.47. And then you're going to add on 0.06. So that should hopefully get you 12.64%. So we'll go 12.6%, which is your cost of equity. So we'll just do that to 2 decimals. 12.64. So just depending a small bit of rounding. But the key point is know your formulas and know what goes in. It's the adjusted price, X div, and you're given G already. You may have to calculate growth rates using your B times R formula or your historical growth rate, or the examiner may simply give it to you as they have here. So that's most likely 2 marks, 12.64%, which is your cost of equity. Now while we're here, you may as well, to finish it off, get your market value. Because you need your market value not for part A, but you need it for part B. Now the key thing to be noted here, it's going to be 4.47. That's the price per share. You always use the adjusted price times the number of shares. Now a lot of students will not be paying attention here and they'll say there's 15 million shares. Be careful, that's the amount of share capital. The number of shares depends on the nominal value per share. That means we need 30 million shares to have 15 million share capital. Because 30 million shares at 50 cents each gets me 15 million euro. So you're putting 30 million there. So your market value there, I'll just put in the, tidy it up, is 134.1 million. So just slot that in, and you have your ordinary share capital complete. 134.100. So I'm just dropping the last 3 zeros, and that you can make that easy for yourself in the exam as well. As long as you're consistent with all 3, you're not going to lose marks. So your equity is 134.1. Now let's do our preference shares. Preference shares you assume are irredeemable unless told otherwise. And we're told here they're currently trading at 72 cents. Dividends are paid half yearly, and most recent dividend was paid 1 month ago. So in your mind, that 72 cents is X div. It's recently been paid, so it's not included in the price. So again, go back to your table. How do we get the preference dividend cost? Preference dividend, price X div times the number of shares. That's fine. And to get the cost of the pref, you put the dividend over the price. You do not multiply by 1 minus t, because preference dividends are not tax deductible. Okay, so let's go back to the question. We have KP, as we'll call it, cost of the preference, is the dividend. Now remember how preference shares work. The dividend is a fixed 6% on the nominal value. It's not 6% of the price. It's always 6% of the nominal value, which is €1 here. So it's 0.06, which is 6% of €1 is 6 cents. And you divide that by the price, which is 0.72. So 0.06 divided by 0.72 is 8.3%. So the cost of your preference shares are 8.33. And you get your market value. The number of preference shares here must be 9 million. So 9 million share capital at €1 each. So it's going to be 9 million times 0.72, which is 6.48 million. So I'll just tidy that up as well. 6.48 million is the market value of the pref. So we'll slot on those 2 figures again getting marks as you go along. And my idea is always keep the hardest one to last. Do the easier ones first and slot them in. 8.33% and 6.48 million. Let's tidy that up. 6480 and 8.33%. So we're working through them. We have 2 out of the 3 complete. And the hardest one that's left is the redeemable debenture. So it's trading at 97 x interest, so no adjustments required. And it's redeemable at the end of 2022. So you're currently at the end of 2017. So 18 is year 1, 19 2, 20 is 3, 21 and 22 is a 5-year redeemable bond. So if we go to the redeemable debentures, you're using the IRR approach. So that's the hardest one. You need to list out the cash flows and make relevant adjustments. So there's typically is a popular one because it's the trickiest. So the way I take your redeemable debentures is a 3-step approach. So we'll come down here and we'll list out the 3 steps. Okay, 3 redeemable debt. Step 1 is list out the cash flows. So the cash flows are for your 5 years. So I'll make this a bit smaller so I can fit them all in. So your cash flows here, you have year 1, year 2, year 3, year 4 and year 5. That's going from 18 up to 22. So we're at the end of 2017 currently. Now the cash flows are, of course we have to add a year 0 as well. So let's make this a bit bigger. So you have a year 0 and up to year 5. Cash flows will be, the current price is trading at 97. So I always put this as a minus. I put the first cash flow as minus and the rest of them positive. You can do it the opposite and you may see that in certain solutions. That's fine, but it slightly changes how you use your IRR formula, which will confuse students compared to what we've done in Invest in Appraisal. So my advice is leave the first one negative, and then each year the cash flows will be, it's an 8% loan note, so it's redeemable. That means it's going to be €8 each year in interest. It's 8% of the nominal amount each time. So it's 8, 8, 8, 8, and the last one is 108. Because you get back the 100 and you also get back the interest. So that's your starting point, is list out the cash flows each year. Step 2 is your tax adjustment. Now just be careful here. You do not adjust the 97, nor do you adjust the 100 at the end. The only thing you're adjusting here is you're adjusting the interest each year, because only the interest on debt is tax deductible. And what we're doing here is we're multiplying by 1 minus 0.15. So you're going here, it's going to be 8 times 1 minus 0.15. So times 1 minus t, which is 6.8 for each of these. And in year 5, it's going to be 106.8. So that's the way I'd always put it out logically in steps. First step, get the cash flows. Second step, adjust for the tax. And now the third step really is we're going to get the IRR. So step 3 is IRR. Now my usual rule of thumb is you're not given any starting point. I would usually start with 10%. And that will give you a guide then whether you need to go higher or lower. Now, when you have 5 years or any similar set of cash flows, I would split that into an annuity. Because you can do the individual years if you wish, but you're going to waste a lot of time. So the way I would look at that is, you have a year 0, a cash flow of minus 97. And the present value of that, if I do it here, the present value will be minus 97 as well. Because if it's in year 0, it's always going to be at its present value. Then from years 1 to 5, you're going to have 6.8 each year. So that is an annuity, and we're going to get the annuity factor tables at 10% for 5 years. So try and condense down your work, don't duplicate your effort. So if we come back here to page, we'll say 15, we have the present value tables we want the annuity tables. 10% for 5 years is 3.791. So we're looking there for 3.791, 10% for 5 years. and that's my annuity factor. So the present value of those cash flows for the full 5 years, present value of annuity, is 25.77. This is the figures we're looking at here. And then you have 1 year 5 cash flow of 100. And we do that by getting the present value factor in the previous set of tables. You don't want the annuity here. You want single cash flow, 10% for 5 years, is 0.621. See it here? 0.621, which is 62.1. And that is how you get your net present value. You add the 3 of them up, and that says at 10%, this set of cash flows gives me a negative NPV. So that means my discount rate, and be careful, my discount rate is too high. It's not returning 10%. So let's go an alternative. We'll go 5%. And we'll get the present value at 5%. So similar to our initial one, the 97 does not change. Year 0 cash flow, it'll still be its present value. What will change now is the 6.8, same cash flow each year, but the annuity factor will now change. So if we go here to our annuity tables, we're now only looking at 5% for 5 years, is 4.329. That means the present value of this is now gone to 29.4, which should make sense because the lower the discount rate, the higher the present value. And the 100 cash flow at the end of its life in year 22, which is 5 years' time, that's going to be a single discount factor, 5% for 5 years, 0.784, which is 78.4. So the present value then at 5% is thankfully 10.83. So we now have negative NPV and a positive NPV. And that's ideally what you want when you're doing an IRR. And remember the IRR formula, it's called the interpolation method. That is given to you in your notes. So after the tables, you can come down. It's not on the first page. It's here. Your interpolation, which I'll just snip and bring in. You're given that, so you don't need to learn it off, but you do need to know how to apply it. And remember, just always use your rule of thumb before you apply the formula. Think, well, where should this be? Well, the IRR has to be between 5 and 10. And these are pretty much nearly equidistant from 0. So it should be somewhere around 7.5. So if you don't get that, you're gone wrong somewhere. So your IRR, just to sub in the formula, and again, maybe pause this now and try it yourself before you see me do it. Rate 1 is always the lower discount rate, 0.05. And then you're going to add to that plus, just watch your formula here, NPV1, which is 10.837 times the difference in rates, 0.1 minus 0.05, divided by, just be careful here, 10.837, and a minus becomes a plus 9.121. So that's where students usually get caught out there, is they don't do the minus. So I'll just do that formula then. So hopefully you got then 0.05 plus 0.0275 gets you an IRR of somewhere between around 7.7%. 7.71%. So again, that's within our rule of thumb. It's between 5 and 10, and it's about equidistant because these two are about the same distance from 0 as each other. So again, make sure you go back. The main thing is I always put the negative figure first and the positive second because that means the IRR formula works similar to what we've done with investment appraisal before. So make sure you know that it's a commonly asked one. So we have our IRR. That's the after-tax cost of debt. We've already adjusted for tax. And to get your market value, you're going to be multiplying the number of bonds times the value. So if we go back to the question, there is 10 million in loan notes and they're trading at 97%. So 10 million divided by 100 multiplied by 97. So the value there is 9.7 million. 9.7 million. So we'll slot both of them in. 9.7 and 7.71%. So I'll make this a bit smaller again. So make sure you go back and practice those. So that means 9.7%. 7%. And then we have, so that was 7.77%. 1%. And this was 9.7 million. So we now have the three elements done, and now all we have to do is calculate the weighted average cost of capital. So there's what the bulk of your marks. Of the total 11 marks, you've probably got 9 marks already. So individually you build them up. That's where your summary study sheet is very important that you know it and practice it. And now we get the total market value of the company is 150 million. And you get your weights by figuring what percentage of that 150 is in the form of equity. So the ordinary shares represent 89%. Your preference shares represent a very small amount. They represent 4%, and your debt represents 6%. So we'll just round those to make them a bit neater. And of course that total has to come to 100%. Just always check you've got your weightings correct. So you can see here then, we're trying to calculate what our Wacc is. You calculate your Wacc by saying 89% of the business is financed by 12.6%, 4% of the business is financed at 8%, and 6.5% of the business is financed at 7.71%. So to get the weighted average at the very end, you merely multiply the weight by the cost and add them up. So it's the weight times the weight times the cost, and the weight times the cost. And by adding them up, you're saying the overall, it's going to be lower than 12.6 and higher than 7 and 8, because it's somewhere in the middle, and it's coming to 12.1. So your overall weighted average cost of capital there is about 12.14%, or thereabouts with rounding. Now that's important to make sense. If I got that right, well, you're saying the majority of the business, nearly 9/10 of it, is financed at 12.6%. So that makes sense. It's going to be close to 12.6 and slightly lower because 10% of the business is financed at about 7 or 8%. So that does sense check where it should be. And that it will be 11% of your paper. For a nice 2 marks, so again, note theory is important in these questions as well. Advise one possible way it could reduce its current weighted average cost of capital. So we know from studying capital structure, you want to try and lower your cost of capital. And what we can see here is there's a very low amount of debt and low amount of preference shares in their capital structure. So one way could be to increase the level of debt, perhaps up to 10, 15, 20%, and that will bring down your overall cost of capital because the cost of debt is cheaper than the cost of equity. So for 2 marks, a reasonable recommendation there would be to increase the level of debt because they have spare capacity. They are lowly geared already, so they have some capacity to take on extra debt. And the second part of this question introduced the other way to get your cost of equity. The first way we looked at was the dividend discount model, and now they're asking you for your capital asset pricing model. For 1 mark for calculation, and then there's 6 marks going for narrative. So don't ignore the theory around Cap 1 finance. It is an important element of the exam. So you're told here the risk-free rate, the market return, and the equity beta. So the Cap M, remember you will be given your formulas in the exam. If we come back here, they give you the Cap M, so it should be relatively nice 1 mark. That the return on a stock J is the risk-free rate plus beta times the return on the market minus the risk-free rate. So again, we'll just snip that and bring it in. but try and know which formulas you're given. It makes your life a lot easier in the exam. So here, the cost of equity using the CAPM will be 0.04, which is the risk-free rate, plus beta of 1.5 times 0.1 minus 0.04. So that is 0.04 plus 1.5 times 6%, which is 13%. So your cost of equity there, it doesn't have to be the same as the dividend discount model. There are two different models. So don't think it has to come out the exact same. That's the formula you use. And this figure, RM minus RF, is often called the market risk premium. So they can tell you, they could say there the market risk premium is 6% and you sub it in directly. But if they tell you the market return, then you have to take off the 4% to get to it. So just be careful what you're given in an exam paper. But that's a simple 1 mark, and you have the formula already given. Part 2 then asks you the difference between systematic and unsystematic risk, and one example of each. So unsystematic risk is known as specific risk. So unsystematic is specific to the particular company you're looking at. So an example could be that the managing director gets fired, that the company has a fire in a warehouse, or that it has some operational issue that causes a big issue such as a strike or industrial relations. So it's specific to that company, and it can be diversified away. Because if you just hold money in that company, of course you're exposed to it. But if you hold a diversified portfolio, you should not be that exposed to risk in one individual company. On the other hand, systematic risk cannot be diversified away. That's the risk to the system. So think of the word system. So that's the risk of the economy, right? That's the risk of exchange rates, inflation, government changes, and that cannot be diversified away. It's systematic right through all portfolios. And the logic of CAPM says you should be rewarded for systematic risk only. And that is what your beta measures. So your equity beta is a measure of the systematic risk in a business. So that's what it measures. What's the relevance of having an equity beta of 1.5? That means you're more riskier than the market. So Trini is riskier than the market. If the market goes up 1%, Trini will go up 1.5%. But if the market goes down 1%, Trini will go down 1.5%. So it is more volatile than the market. That's a measure of risk. The beta of the market is 1. Lower than 1 beta is less risky. Higher than 1 of a beta is more risky. And that's all you're simply looking for to get your 3 and 3 marks there. So what we can see from this is there's nice calculations, very repetitive if you've practiced previous exam questions, and try and use the summary study sheet to make it easier to learn off how to do the cost of capital for each item. And also note here, if you're looking for 20 marks overall, there was 6 and 5 is 11, 11 and 1 is 12. 12 marks for calculations, but there was 8 marks for theory. So theory will form a good part of Cap 1 Finance overall. So that was Summer 18, question 4, focused on the area of cost of capital.